Good afternoon, everybody. Uneducated economist here. Thought I'd talk a little bit about gold this afternoon. Many times I hear about how the dollar is going to fail as a world reserve currency, and that does make a lot of sense when you see the nations out there who are conducting themselves in a way that appears that they are getting out of the dollar. When you have Russia selling oil to India in rupees, or when you have like nations like Saudi Arabia who are willing to sell oil to China in yuan. These are like actions that would really appear that would be outside of the dollar, and how that dollar is losing that status and is eventually going to fail. And it does appear that way when you look at it, but when you think about it on the bigger grand scale of things, you would see that the dollar is really in a position that there is no other nation that can even come close to touching it when it comes to issuing out enough currency to provide to the world in order for them to do business in that particular currency. Now, I know that starts sounding really confusing, but there was a time in which that all settlements were done in gold, right? So if you think about gold being the ultimate asset for settlement, no matter what you did out there, at the end of the day, you knew what you were going to get. You were going to get gold as far as the contract in the settlement of that contract. As time went on, we eventually left the gold standard and moved into a fiat standard. But why did that occur? Like, why is it that people just kind of accepted this idea that we were going to be moving from a gold standard into a fiat standard? Now, I understand that, a lot of people say, hey, there just wasn't enough gold. And in a sense, yeah, that's true, but it's not really true. What ended up happening is that as the United States was a manufacturing powerhouse and we were exporting a lot of stuff to the rest of the rest of the world was sending us their money. And at the time, it happened to be gold. So the United States started accumulating a lot of gold. And now when it got to the point that the rest of the world is deprived of gold, well, then what happens is that there's a slowdown that takes place, because they can no longer buy your stuff because there's no more money out there for them to buy stuff with, right? Boy, I'm having a hard time talking. And that's when your production starts to fall and eventually fall into poverty, and that distribution of gold has to go back out to the rest of the world, as you need to start buying things from the rest of the world in order to survive yourself. So now that's kind of all of it in a nutshell. But the United States didn't do that. They got to a point where they realized, oh man, we've accumulated a lot of gold here, and they started issuing out currency to the rest of the world. They're saying, hey, here's some fiat currency that we can use. And they started going deeper into debt by issuing out treasuries. Now, this is something really important to understand, is that the deeper that the United States goes into debt by issuing out those treasuries, that's what they're doing to provide the world with that safe and liquid asset, those U.S. treasuries. And that's important to understand, because that ultimately becomes the currency that we use today. Not like you and me when we're like go down to the coffee stand and we're buying a coffee with money. That's not what I'm talking about. I'm talking about on the grand scale, on the bigger things, when you have international trade happening. Because those nations, when they're doing deals, they're doing them in dollars, but they're not even really doing them in dollars. What they're doing them in is U.S. treasuries, because if you're holding a U.S. treasury, at least you can get some sort of return off of it. When you hold cash, it's actually kind of dangerous in the sense that you may lose your purchasing power over time, right? Or you have to deal with the fact that there's transferring fees and issues with storage and all that. So money, cash itself, comes with a cost, but U.S. treasuries come with an interest rate attached to it, so you at least get some sort of return off of it. And now this is really where the dollar is king of all of it, right? Because the United States is willing to go that deep into debt in order to issue out the U.S. treasuries that everybody uses as the currency, or the settlement in trade. But the settlement itself at the very end of the day is going to be the dollar, which is the cash that we use, right? So although the U.S. treasuries are essentially what people hold in order to facilitate trade, cash is the settlement at the very end of the contract that is needed in order to get out of the contract or complete it. So it's like the lubrication for the system. Now, if you can kind of wrap your head around all that, you can kind of see that if we were to go back to a gold standard, it would be very difficult. How is it that you transfer this gold from one nation to the other? Well, you're going to have like security issues, transportation issues. You're going to have, all kinds of like costs that's associated with making this transaction happen. So then what do you have to do? Well, then you have to put it in a third-party storage and then lease it out. And then lease it out at some sort of interest rate, right? Because somebody's going to say, hey, man, I need to get paid back at something on this, right? So you create a contract of a gold lease that starts getting used as the international trade. And again, somebody's going to end up having to get paid, that third party, for being the storer of that gold. Does all that kind of make sense? So now here's the situation that we're really in, is that you have this fiat currency, or you have the gold option, because there's really nobody in between who can facilitate this trade. Now, when we think about like, okay, so we're going to get out of the dollar and get into gold. What's going to happen to gold? The gold price is going to start moving up dramatically. Now, if we are going to get out of the dollar, something else interesting is going to happen, is that the dollar is going to also rise. Because if you think about like how all international trades, not all of them because of the BRICS nations and them doing their deals, but for the most part, all international trades are done with dollars. So even if two nations are looking to do deals with each other, it doesn't have anything to do with the United States, doesn't have anything to do with our corporations, our government, our banking systems, nothing, like not our people or anything. But these nations are wanting to do a deal with each other, and they do them in dollars, right? So they write that contract in dollars. Well, if they are to not write that contract in dollars, what's going to happen is it takes dollars out of the international system. Because when they write that contract in dollars, not only do they get the dollars for the contract, but then the contract itself then gets used as if they're dollars out there. You see what happens? Now there's two sets of dollars, right? The contract and the actual dollars that are out there, but this expands the dollar system that is being used on a global scale. So if you start taking away those contracts, nations don't want to deal with dollars anymore. They're getting out of it. They don't want to do any deals with it. They're not going to have anything. They're not messing with it at all. They're going to move over into gold and start dealing with gold. Those are dollars disappearing out of the system. And when that happens, the dollar value, the dollar strengthens, starts to move up because there's less available dollars out there to conduct the world trade that's happening. As they start moving into gold, gold prices start to move up. So you can see that the dollar and gold are going to rise together. So how do you deal with this? Like, do you go and you buy physical gold? Do you go and you stack up a bunch of dollars? That's where the sponsor of today's video comes in. I would like to thank US Gold Mining Incorporated for sponsoring today's video. You can find their ticker symbol at USGO. Now, first of all, when it comes to like looking at a company like US Gold Mining Incorporated, the very first thing that I do, now I'm not a financial advisor, I don't give financial advice, and if you do invest in a company, I would suggest that you do go and find a financial advisor that you can trust. But I go and I look at who's running these companies. Now, to be honest with you, I don't know anything about gold, right? I don't know anything about gold mining. I don't know anything about like how do you pick out a good gold company. What I do, again, is I look at the company's CEO. And now Tim Smith, 25 years of experience in mineral exploration and mining. Now, this is something to think about because he has a proven track record of discovery and mine development in places like Australia and Canada, with not only like the junior miners, the mid-tier miners, but also the major miners. So this guy has been involved in the game for a long time. And when you look at some of the companies that he's worked with, like Goldcorp and Newmont, these are not like small players in the game. These are people who really know what's going on, and he was involved inside of these projects with them. Now, also, he was the previous VP of exploration that led to the discovery of the coffee deposit, which apparently was quite the discovery, and it ended up selling for 520 million Canadian dollars to a larger mining operation. And that's what a lot of these companies are doing, like Gold Mine, is that they are buying the mineral rights or the rights to explore or the rights to develop and mine, and then own these things in a position, or be in a position in which that the availability of the project then comes online and they're able to sell that off for a higher price. And that's a lot of what these guys are up to, is just finding these actual projects that are out there for future development. And that's where this Whistler project comes in. This is something that I had looked at a couple of years ago, or a year or so ago. And this Whistler project, it's huge. It's like a huge mining, or a huge gold deposit, and it's like not that far away from Anchorage. It's like 105 miles away. The problem with it is that there's really not a good system of how do you get the product from the mine to like the ports, to the rails, to the locations in order to distribute. And that's really where this is like a lot of mining operations find their issues, is that, yeah, they know that there's gold there, they know that there's a deposit there, but then how do you get the deposit to the market? Like, it's way out in the middle of nowhere. It's not like you can just like, pick this stuff up and truck it in. You need roads and rails and all kinds of stuff. Well, that's where this Whistler project comes in. It's 105 miles northeast of Anchorage, Alaska, right? And this is where the kicker is that there's a state-led initiative to build the future access road to this location, right? Going right to, what is the name of the port? Port McKenzie is the name of this port there at Anchorage. And so this is and they're serious about it. They've invested $8.5 million into the research of what it is that's going to be needed in order to develop this access road from the Whistler project that U.S. Gold Mining Incorporated owns to Anchorage, to this port, McKenzie, so that the whole chain is completed from from the location to being able to provide it to market. Now, why is this Whistler such a cool place to invest at, right? Or at least to look at as far as future possible mining operations. Now, again, like, what do I know about mining, right? So when I look at this company and I look at the market cap and I think about like what it is that they have available up there, right? So from the explorations that they have done, they know that there's 3 million equivalent indicated, right? They know there's 3 million ounces of gold up there from the testing that they've done. But because of some of the geological surveys and them being the professionals that they have another inferred 6.4 million ounces that they haven't, confirmed that are there. But they're pretty sure that there's an equivalent of 6.4 million ounces of gold that's going to be up there for them to mine. Now, they know about the 3 million, but plus the 6.4 million that could possibly be there, and a market cap of $190 million, right? Because I think their stock is selling at like $15 a share, $16 a share. So if we take the $190 million market cap and we divide it by $15 per share, that works out to about $20, right? So you can own a piece of this company that's going to be equivalent to $20 an ounce, right? 90 million market cap, 9.4 million ounces, $20 an ounce for a $15 purchase into this company. Seems like a pretty good deal. Now, again, I'm no financial advisor, and I would suggest that you do seek out the advice of a financial advisor before you invest in anything. But check out U.S. Gold Mining Incorporated when you're doing your research. Ticker symbol USGO. Uneducated economist, you let me know.